I'm Drew Stevenson. I'm a professor at South Texas College of Law, Houston, and this is the second in a 3-video series about Texas SB19 and SB13. I'm mostly focused on SB19, but they're companion statutes that go together. And these are basically two statutes that the Texas legislature passed in 2021 to punish companies that boycott either the gun industry or the fossil fuel industry. And in this video, I'm going to quickly do a quick recap of what the Texas statutes are. And then I want to focus on either similar or contradictory legislation happening or legal activity happening in other states. So the new Texas statute, SB19, forbids government entities in the state, so that's state agencies or municipalities, counties, towns, and so forth, from contracting with banks for example, financing or underwriting bond issues and so on, if those banks discriminate against firearm or ammunition manufacturers, and basically if they boycott or divest from them in any way. A number of the nation's largest banks, like Citigroup and Bank of America, announced after some of the mass shootings in 2018 in 2019 that they were going to start to step away from the gun industry for various reasons, as I talked about in my first video. And there's a companion statute, SB13, that in some ways is the bigger deal, that imposes similar restrictions for banks that defund or divest from the fossil fuel industries. And we call these anti-ESG statutes, basically to punishing banks for having environmental, social, and governance policies. You should be aware that Wyoming, around the same time, passed a statute that's a little bit different, but is trying to achieve the same thing. So Wyoming enacted a statute, HB 0236 in 2021, that basically creates a private cause of action against the company, like a discrimination statute might do in the employment context. Louisiana has punished banks for divesting from gun companies through its state treasurer and advisory boards. And several states have considered similar statutes about fossil fuel industry divestment or boycotts, statutes that punish companies for boycotting or divesting from the nation of Israel, and so forth. The Texas model, so basically SB 13 and 19, it seems to be the dominant one that has been proposed in several state legislatures. The only state that's enacted it so far is Texas, but it has been proposed in other states, and in a number of states passed at least one of their houses. Now, you should be aware that there's some states that are going in the other direction. So, for example, a few states like California and Connecticut and Rhode Island have taken steps, but not through the legislature, usually through the state treasurer's policies or advisory boards for their state pension funds, to divest the state pensions from the firearms industry. And as have some large municipalities like Philadelphia. And New York State has also targeted firms that have financial ties to the National Rifle Association. Overall, from my view, this is sort of a subset of the larger ESG movement and falls under the sort of social impact or social concern about that a growing number of companies either want to have or are being pressured to have by their investors, individual investors, shareholders, and consumer boycott groups, and so forth. Connecticut's policy, actually, Connecticut's state treasurer went a little further in 2018 and 2019 and now requires banks to disclose ties with the gun industry to get government contracts. In some ways, this is the exact opposite of what Texas has done. So Texas punishes companies. Connecticut doesn't promise they're punishing companies, but it's clear that they have a preference that companies that are going to get contracts with state entities for bond issues don't have a lot of entanglements with the gun industry. And so there's sort of 3 prongs to the Texas program, the treasurer policy. The first is that the state itself their state pension funds are divesting from any public securities of civilian firearm manufacturing companies, and they'll make an exception if the company is looking for a commercial loan to develop smart guns or some sort of gun safety technologies. But overall, they are divesting from the gun industry. Now, on the other hand, it's publicly traded securities, and so there's only very few gun manufacturers that are publicly traded on the stock market now. The other two prongs are disclosure and decision making. So the disclosure aspect, as I've mentioned, requires banks and financial institutions who want to basically do underwriting work for any government entity in the state. They have to disclose to the state treasurer their policies on guns. And now this doesn't mean that they will be barred from the contracts. Like the Texas statute creates an absolute bar, or debars them from getting these contracts, forbids municipalities, for example, from going with a bank, even if they're the best bidder, lowest cost bidder. Instead, in Connecticut, it will weigh the financial institution's gun policy as one factor among many when the Treasurer's office contracts with for banking and financial services. I pulled out a quote here that I want you to look at, because apart from the sort of political motivations that may be behind either the Connecticut policy or the Texas statute, there is a financial issue here about whether the gun industries are a good investment. And this is the explanation from the side that would say that they're not, that gun companies and gun stores are basically bad for business. And I want to read this to you. From an investment perspective, civilian gun manufacturers face significant legal and reputational risks that have an impact on company profitability and long-term shareholder value. Often a volatile investment, these securities present unnecessary financial and business risks associated with the products manufactured. The U.S. Supreme Court's decision to allow the families of Sandy Hook victims to proceed with their claims against Remington Arms underscores these risks. As state treasurer, the costs and risks of gun violence are a matter of significant financial concern, and the business of guns is becoming an increasingly risky proposition. So apart from questions of Second Amendment rights or gun rights, or the kind of unending public discourse about whether guns make us safer or more create more danger, more at risk, the fact is that you can make an argument that gun companies, they go bankrupt, right? They have kind of wild financial cycles of sales spikes, and then sales will kind of drop through the floor and so forth. So it's an unstable investment, and it also poses there's growing concerns about legal liability for the manufacturers, especially if the federal statute that gives them immunity from lawsuits is repealed. And then there's reputational risks, right? So it reflects badly on a company and makes the company complicit in the minds of many investors, and can interfere with their ability to get business elsewhere. Now, you should be aware that we have two tiers of kind of regulation or legal things in our society: the state level and then the federal level. And we have had some activity in this area on the federal level as well. My third video is going to be about something called Operation Choke Point, and federal regulatory efforts a few years ago that may or may not have impacted the firearms industry. But the most recent activity, though, was with the OCC. That's the Office of the Comptroller of the Currency. They're one of the main agencies that regulates banks. And in late 2020 and early 2021, basically after the election, the 2020 election, an acting director who was appointed by then President Trump proposed a federal rule or regulation that would prohibit banks from these, what they call discriminatory lending practices, like having climate-friendly policies or divesting or defunding the firearms industry. And This was controversial and kind of edgy, but would have basically done the same thing through federal regulations that the Texas statute has done. It sort of mirrors that. When President Biden came in, he appointed a new acting director for the OCC who immediately shelved the rule or rescinded the proposed rule and said, we will wait for the confirmation, a Senate confirmed comptroller of the currency to revisit this issue. It's very unlikely that a comptroller of the currency appointed by the Biden administration would want to punish financial institutions that divest from the fossil fuel industry or the gun industry. If anything, they're likely to do something more like the Connecticut Treasurer's policy. And that concludes my second video out of 3 about SB19 and SB13.